I want to talk about systemic risk and acute market moves, which you brought up earlier. So let's address the last semi-acute market move we had earlier in the month. Uh, it was less pronounced here in the US, but globally, like Korea, for example, August 5th, August 5th, and the Nikkei was down so much that that they had to trigger the circuit breakers. But anyway, what caused that? There's been debate as to whether or not the yen carry trade unwind was the sole cause. What do you stand on this?
Well, I study how hedge funds are positioned for a living, and have built technology that lets me see what's going on. And a lot of the driver of what we saw was the second and third order consequences of hedge funds being caught off sides and other levered investors being caught off sides on certain positions, which created second and third order knock-on effects in the global asset markets. And so really what happened was this all started with a slightly softer CPI report, which created a rotation away from growth stocks into the Russell 2K stocks by
That was July,
um,
right? You're talking about July?
yeah, by
Yeah.
July, by market neutral hedge funds. That then created increased perceptions of risk, which caused broader hedge fund and levered books to start to delever, um, particularly where they were over positioned, which was really in places like the stock market. And so what was happening was those levered entities, those levered hedge funds what they were doing was trying to catch up on returns by going long high growth stocks. And when those underperformed, they had to cut those books. That created a drawdown in the stock market, which created concerns about the fact that the Fed would need to cut, concerns about growth, and the fact that the Fed would need to cut. You saw a sharp move in the 2-year interest rate and the bond curve in general. That created a very direct knock-on consequence on the yen. I won't go into all the details, but the linkage is bond market, the US bond market drives the yen and not the opposite way. And so therefore what happened was the yen rallied a ton in response to the US bond market action. And then as a function of that, the Nikkei then fell because most of those companies have, vast amounts of foreign earnings, which are when priced in yen, when the yen rallies, they underperform almost mechanistically as a function of that because their foreign earnings become less valuable. And so that's the knock-on effect, not the other way around. The yen carry trade, like in terms of orders of magnitude, just think about it this way. The amount of losses on yen carry positions were probably, I don't know, 10 billion during that period. And the total losses in the US, in the global equity markets were 6.5 trillion. Like the orders of people saying that it was the yen carry trade driving the rest of the market action, like the orders of magnitude aren't even in the ballpark. It's a silly way. It's typically indicative of someone who doesn't actually truly understand the inner market action of the way the global financial markets work when they say it's the yen carry trade instead of saying it germinated in the US and then had knock-on consequences elsewhere.